Hello, Dilly. How are you?
I am doing really great. How are you, George?
Doing well, thank you. We missed you yesterday. I
Yeah,
understand you.
thanks.
I understand you weren't feeling too well, but I'm glad you're back.
I'm back. I'm feeling
Yeah, I don't
great
know.
today.
I don't know. I don't know how I could deal with. I'm teasing him, but Rob was great yesterday. But I don't want this to
Did
become
he
a.
did he keep you in line?
He kept me in line, but he doesn't have your bedside manner, so
Thank you.
it wasn't as good. It
Thank
wasn't
you.
as good, and so good. I'm glad you're feeling better. Um, I know there's a whole bunch of earnings that have come out.
Dude, did you see? Like, yeah.
Well, what were you going to tell me, Dilly? What were you going to tell me?
I was gonna tell you that like there are a lot of earnings that are double beats right now, it looks like.
I understand. Should we
Mm-hmm.
have break? Should we have
I'm
break in?
curious
Hey,
if you're gonna be bullish or you're gonna be bearish today. I'm excited.
no, I flop with the wind.
Mm-hmm.
I'm like Cheech. I'm always on the right side of the market. You know how it is.
Oh, okay.
So exactly.
Okay.
So we can talk about some of that later. But what am I triggered about today? Because usually, I'm always like fired up about
Well, do
something.
the green candles trigger you? Because there's a lot of them.
No, that's not what triggered me today. We'll talk about the green
Okay,
candles in a
all
minute.
right.
What triggered me today was you, you recall how I get annoyed when you have all these one-liners flying around Twitter, and everyone's an expert in whatever the subject du jour is, whatever the hot take is. Okay, and so you get these. They go from like no one's ever heard of it to like Captain Obvious, right? So go back. We've talked about this before. U.S. exceptionalism, or when we had the whole Nvidia debacle at the end of January, people are going on about Jevons paradox. And now the new one today seems to be everyone is tweeting out items about everyone's a container shipping expert now, right? If I see one more tweet where someone's got like a map of ships on the ocean and explaining how all these vessels are stuck in port, and another, live footage, Dilly,
Yes.
from the port of live footage from the port of Long
Wasn't
Beach
that
or
like last
Seattle.
summer that everybody was a shipping container expert too? I
Well,
think
they're actually they're
they're
back. They're
back.
back.
Oh,
They're
they're
back.
back.
They've been in retirement. They're back now.
Okay.
Okay, so you get all these pictures of guys from the port of Seattle
Yeah.
or Long Beach or whatever.
Dude, I
Jesus
learned
Christ!
so much about shipping containers last summer.
you
I
might you
never
must
thought I
be
wanted to learn any of that, really.
Dilly. Do you use that for like pickup lines and bars and
No,
stuff?
but
It's like
maybe I should try. Like maybe that would help. I don't know.
it's like I'm punchy. Oh God. So anyway, we'll talk about earnings later. We can talk about container shipping if people want to, but I'm fired up. I gotta get this
Yeah,
out of my
you
system.
really do.
I gotta get
I
this out of my
I
system.
can tell.
This poor guy just happened to be in the wrong place at the wrong
Oh
time, and
no.
he's now gonna get it from me. Okay, I got annoyed. I'm sure he's a good guy, and we all do this. So I'm actually hoping that we can learn from this. I have to put this up in the nest. But so I sent out a thing earlier today, a couple hours ago. I went like on my. And by the way, it's Dilly. If this space blows up, it'll be because Elon's listening to us. Because I kind of saw I went on a roll with some Tesla stuff before the space started, and people were just like piling on. They love it. And David's going to talk about Tesla actually in a little bit. David, I got to mute yourself. I got to mute you. And David, please mute yourself.
I was I,
No, David, stay muted, please. Stay muted. Hey, Dilly.
Yeah.
I just want to
Poor
let you
David.
know.
Poor
I know.
David.
It's his first time on. It's not time for him to talk.
Oh
He'll
my
talk when he's
God.
supposed to.
David, we'll be with you in just a moment.
Yeah, we got unfinished
George
business
is
here.
triggered. Just like
Hi,
let him
Dilly.
breathe a second.
Dilly, I don't know what is wrong with me. Probably because I haven't been out of the house. I am so punchy right now. Okay,
Yeah,
so
you got to get it out.
by
This is also why
the way,
415 space is
Dilly,
so much
Dilly,
better.
Dilly, Dilly,
Yeah.
Dilly. I almost had, and by the way, it's going to be inside joke, but for the regulars in the space, they'll know where this is going. They'll know what we're talking about.
Yeah,
I,
what?
I almost had a Leslie Nielsen moment just before the space started.
Oh God.
You know, Dilly, you know what happens when there's a hot mic?
Yes,
You
I
know,
do know what happens. You did that again?
well, almost. I,
Oh
I had
Lord,
to,
George.
I had some,
Now you're manifesting it to happen.
I
For those
know,
listening, he's
but,
talking about
but,
peeing on the mic.
Dilly, you have to say it. I was going to make people go back and listen to the replay. I was
Oh,
figuring
sorry, that
anything.
was a hook.
Exactly.
So sorry.
Oh Lord, I don't know. I may have to have you run this space today. I can't. I think Trader got me all pumped up. I don't know what's going on.
So did you
I
clap back at the guy about the shipping containers?
No. You know what? You know what? I'm going to save this story for later because I don't want to take away from David's
Yeah,
time. We
let's
can talk
talk
about
to
this later.
David.
Let's talk to David. Okay, so let's talk to David. So, new constructs research. David Trainer has been at this. David, welcome. Good to see you, my friend. You can meet yourself. You there, David?
I'm here. Glad to
Excellent.
be here.
Good. So I recall new constructs. You've been at this what for 22 years? Is that right, David?
Yeah, and before New Constructs, I was working on the same kind of stuff. So I've been doing forensic accounting and machine learning AI for 25 years.
Awesome. I recall looking at your CV the other day when you and I were chatting. You were at first Credit Suisse First Boston back in the day. Is that right?
Back in the day, before, during, and after the tech bubble,
You've seen it all.
seen it all.
There you go. So, all right. So, David, New Constructs Research. I'll let David explain what they do, but basically, he's a stock picker, and unlike all of us who follow narratives and may have an ability to not be so objective from time to time, as I'm reminded, I can't remember where the saying came from. Liars figure, but figures don't lie. And David's stock picking service his system, his way of looking at things is quite interesting. David, I will put up in the nest. You sent me the graphs of the performance. I think they're 5-year returns. And so anyway, why don't you start cracking? And as you're talking, I'll put up some of these graphs so people can see what you're about. Welcome, David, and the floor is yours. How about it, David?
Yeah, thank you, George. Nice to meet you, Dilly.
Nice to meet you
Yeah,
too.
so thank you. Yeah. So we're New Constructs is a sort of a new paradigm in fundamental and stock research. Uh, the effectiveness of our approach is proven in these indices that Bloomberg created, a family of indices around our proprietary stock ratings and data. Put it simply, I've cracked the code on how to read through all of the corporate filings, the financial filings, 10Ks and 10Qs, 8Ks, so that we can pull out what is a more robust and superior measure of earnings. And our approach has been written up for Harvard Business School students. I guest lecture usually once a semester at Harvard Business School about our unique technology. And then Harvard Business School and MIT Sloan professors published a paper proving that the rest of the market is missing this critical data in the filings, footnotes.
Yeah, David. Let me interrupt for 1 second. If you look above your head, you'll see something that says "Share by George Noble," a small print. If you touch that, you will see the tweets that I sent out. So the 3 slides. I'm going to put up the performance data in a second, but the three introductory slides with the citations by Harvard, MIT, E, and Y. And then showing the sum zero, you've been ranked, number one for 46 months or whatever. That's all there. So just so you know, the folks can see that. Go ahead, David.
Yeah, and so look, performance matters, but what really matters to me at the end of the day is doing what's right and giving people access to the truth. We were joking about my time at Credit Suisse, and what I saw as a young professional on Wall Street was, just grand theft Wall Street. And some people may remember the Elliott Spitzer settlement, the global research settlement, where the Justice Department rung up or the SEC rung up the Wall Street firms for like 10 billion bucks, and it was a big deal. And I think Credit Suisse itself was a billion, and it was still pennies on the dollar for what they made during that time. I met with analysts who told me flat out it was a joke that people would invest in these stocks that they were writing up so positively. I think they were busted by the Justice Department for sending emails right after publishing a glowing IPO report, telling their friends, "I can't believe anybody's stupid enough to invest in this piece of blank." And so what I realized at that point in time is that, look, if I didn't create a technology to go through and pull all this important data out of the fine print, it was probably going to be lost forever. And if not forever, for sure, until someone in the future decided to build something, because the very people that were supposed to be doing the diligence on all these stocks, well, you couldn't trust them to do it anymore. Wall Street had completely been taken over by its lust for money. There was no integrity left. And they some people went to jail for a short amount of time, and there were huge amounts of money fined to these folks. But at the end of the day, the more important problem was the fact that how was anyone going to get to the truth about profitability and valuation if there wasn't anyone out there digging through these 200 to 2,000 page filings that companies have gotten so good at burying information in? So that's really why we put this together. I felt it was important to the integrity of our capital markets, because I believe the integrity of our capital markets is important to our country. If the one thing that the United States has done better than anybody else in the world since our country was born is allocate capital to its highest and best use. That's why we have the biggest, most successful companies and the most innovation in the world, for that exact reason. And people can't allocate capital to its highest and best use if they don't understand which companies are really profitable or not. And we've got examples, tons of examples. Our zombie stock list, you can get it for free on my website. Those are stocks that we think are going to go to zero, and great examples of misallocation of capital. And when I say misallocation, it's not money being lost. Oh, it's money being gained by Wall Street insiders tricking unsuspecting investors into giving them money. WeWork is a great example of that. We were one of the only, and I think the first research firm to come out and say, this is the most ridiculous IPO we've just about ever seen.
Hey, David, you're a little bit muffled right now. I'm sorry. Sorry, go ahead.
My bad.
Go
Yeah,
ahead.
we were one of the first to come out and say this was the most ridiculous IPO we've ever seen. And a few months later, they pulled the whole thing. But we pointed out the ridiculousness of that, as we point out the ridiculousness in a lot of zombie stocks and other stocks. We call it like it is. We've also got plenty of great ideas. I mean, some of our best ideas, or our top ideas, are up for the year, outperforming the S&P by 15-20%. And then, of course, the indexes that you've shared, I think, George, at least on Twitter, those are live traded examples of exactly how our data and our proprietary research outperforms the market. The big deal here really is that we're the first fundamentally driven research firm that I know of that's ever had papers written about how their data is proprietary and superior, and ever had a family of indices out there trading live, proving the outperformance of the data, proving the alpha in the proprietary stock ratings, core earnings data that we have. And because people, I think, gave up on fundamentals for good reason. Where could you get good fundamental research until new constructs? Like, you can't get it from, you don't tell me I don't know this crowd that well, but I would imagine that most of them, if they're listening to you, George, they know that they can't you can't trust Wall Street research.
Yeah, no, David, 100%. Listen, I make as many mistakes, if not more, than most others. But I think the reason people don't have to do what I tell them to do, but I think the reason they come in here, at least I believe, is that they think I'm honest, rightly or wrongly. I am honest. I make mistakes, but people just trying to figure out the truth, and I think that's really the extent that folks like yourself can help us with that endeavor. That's highly valuable. I mean, it's funny, David. I think I said this to you the other day. I don't receive a whole lot of Wall Street research anymore. I'm still on a few firms' lists. And initially, because when I got out of the institutional business, they kept me on it for a while, and then eventually I wasn't friends. They took me off of it, and I was initially panicked. Oh, what am I going to do? I'm not getting, I'm not getting research. Dilly, here we go. I'm not getting pay attention to this name instead of there's a new firm. It's not Goldman Sachs. It's not Morgan Stanley. It's not Merrill Lynch. It's Squat and Leave It. Okay, I wasn't getting research from Squat and Leave It anymore. It's like, what am I going to do? Like, how am I going to know what to buy or sell? But I realize that, I mean, that stuff's not worth the paper it's written on. I would actually pay people. It's like buying silence. You got to pay the mob for silence or whatever. I would pay them not to send me this stuff because it just messes up with my head. And actually, David, the quality of research, and you know this, it's never been worse. I mean, there were some decent analysts around back in the day. Maybe not everybody at Credit Suisse was a great analyst, but there were some. But they were somewhat hamstrung by what they could say. But now the conflicts have become so enormous. Anyone with half a brain and a scintilla of integrity, for the most part, they left these firms. They're doing their own thing. They put out their own shingles. So amen, David. Keep going. You're on a roll.
Yeah, totally. I mean, all the good analysts, like, I mean, their goal was always to go to the buy side. Like, even back in 25 years ago, they wanted to go to the buy side, but then they stopped getting paid as much because they couldn't get paid directly for investment banking deals anymore. And yeah, the good ones left, and what they have now is, I mean, yeah, you're right. It's not good research. It's designed to sell you stock,
Right.
just like every conference call is designed to sell you stock.
Right. So, David, tell me. So, explain a little bit about. So, first, explain a little bit how your service works. What goes into it? What are the inputs? And I know there's a lot of common sense behind it, but give us a rundown of how it works. I mean, I'm not asking you to give away the secret sauce to the Heinz ketchup or Coke, but give us outline. And probably even if you told me how to do it, or others in this space, they couldn't do it, so it doesn't matter. But rather than just being a black box, explain to us the process, please.
Yeah, I'm glad to. And this is one of the things I can explain it all I want, because it's still very hard to do. What we do is what Warren Buffett and Ben Graham have been telling people that they should be doing for decades, and that is to go through every single page in the company's financial reports, quarterly reports, annual reports, every single page. You analyze every single page, and you build a model, financial model, that takes into account all the information in those filings, so that you have a truly comprehensive view of the fundamentals of the business. To me, there's no other way to do it. The problem is that if you take a shortcut for any of that, it's like driving at night without headlights. You don't know what you don't know. It's like a doctor going and doing an exam. You say, "Hey, I'm sick," and he or she looks in your ears and makes a diagnosis. That's all they do, right? Wall Street's just trying to get trying to get everyone to pay attention to that one number, that is not representative of the profits of the business. It's highly manipulated as well. I got a great Wall Street story for you guys. When I was at Credit Suisse, I was there before the tech bubble, and so I got to see how the research department changed when Frank Quattrone's team. Frank Quattrone, for you guys who don't know, he was probably the number one tech banker of all time, or was for a long time. When he joined Credit Suisse, I had about 80% of all the analysts around the world were using my superior, better model. Right? We had some big clients: Fidelity, Janus, TIA, CREF. Everybody was on this better model for understanding profitability and valuation. When the tech guys came on, I was having a little trouble getting some adoption. So I met with a few analysts, and I was kind of blown away by what they said. They're like, "What are you talking about? Like, I don't care about that. I got an IPO to get out tomorrow." But then I met with the heads of the equity research department for the tech team. And those guys flat out said, "David, we can't use your model because then people will know that we have two sets of estimates." I said, "What do you mean you have two sets of estimates?" I said, "Oh, come on, David, you know how it works. For the stocks we like, right? You want the stock to go up. Well, if you want the stock to go up, the company's got to beat the number. So for stocks we like, we publish a really low number for estimates to make it easy for them to beat." And I said, "Okay, so then how do you justify your target price if you got such a low number in this?" "Oh, that's the problem. Our real number that we share with our institutional clients is actually much higher than the number we publish." I went back to one of my mentor at the time, this guy named Michael Mobison, and I said, "Hey, Michael, you won't believe what I just heard." And before I could get it halfway out of my mouth, he said, "Stop, stop, stop. Go tell the head of research." He didn't want to hear it because I think that was illegal. If not illegal, unethical, highly unethical. And so the earnings numbers that you're told to watch that are a beat or a miss here or there, whatever, it's all junk. It's all meant
Yeah,
to distract you.
and David, not only is it a whisper number game like it's a national sport, everybody knows. You know that I know that you know it's a scam. But you were talking before about what numbers to focus on, not just the numbers, but metrics. So you're talking about a time back in the day when we had the dot com stuff, and I'm sure you remember like it was yesterday, eyeballs or, all these other crazy things, which don't mean anything really. And so it's performative art, if you ask me. So the whole thing is absurd. And David, as they say, there's a reason they call it the sell side, right?
Yeah, they're in the business of selling stock. I mean, that's what it is. That's what it is. So I got a little bit off track on how my process works. The technology. Well, so I learned how to read all these filings and dissect them into great detail because I worked with Credit Suisse analysts around the world, U.S., London, Europe, Asia, and so I learned where all the bodies were buried. And over time, I started to see patterns. And so when Credit Suisse really failed to implement the business I'd built for them, and I was not surprised. In fact, I left before they finally shuttered the whole thing. But when they did that, when they bought Holt, which was our biggest competitor at the time, that's when I decided I think it'd be a good idea to start New Constructs because I knew that no one could build what we were going to build. I didn't think they could build. And so, really, what that was back in 2003, we started building machine learning large language models. Nobody even knew what those things were. I didn't even use those terms. It wasn't what I called it. I just said, I need an application that can deal with a financial filing, and scan it and identify a bunch of stuff that I'm going to tell you to identify, and then I need you to be able to extract the stuff that I've told it to identify very quickly into a very specific database that's based on an ontology that reflects the economics of a business as opposed to the accounting of a business. Now, I don't want to get dorky and bore people here, but the problem is that accounting was not designed for understanding a business. Accountants count. Financial people analyze. So just think about the accounting data as the vocabulary, and finance is the language. So I had to build a database based on a very robust, comprehensive language around the economics of a business. So that's really kind of the way it all works. And over time, as we collected more data, and by the way, this data collection system was designed for experts to use. And this is a whole thing most people don't understand about AI. If the data has not been collected, curated, and reviewed by experts, the AI is not going to work. That's why ChatGPT and all these other things are hallucinating, and they're having trouble with any kind of inference or problem solving because their data set, the internet, is not reliable. So what I started with building first was a technology to help me build a training data set. A training data set to teach a machine to go through these thousands of pages of filings for thousands of companies at a time. And that's the real trick at New Constructs is we do what Warren Buffett does, but we do it with scale. And I can prove that we do it, maybe not as well as Warren Buffett, but enough to generate alpha that's demonstrated in these slides and these live traded indices that Bloomberg has. And the main thing that the Harvard Business School and MIT Sloan paper proved is that the market is missing footnotes. Nobody in general is incorporating this critical data to understand profitability. And the paper proved that footnote data was highly material to whether or not companies beat or miss and what future earnings were going to be. More material, more impactful, more predictive than anything else that's ever been, which is why there's alpha in that data. And so, yeah, in some ways we're old school because we're doing it the way the all-time greats said to do it. In some ways we're new school because we're using the latest in technology to effectively create what I would call a value investing 2.0, where we're getting machines that we know we can trust to go through and do all this work and measure things like core earnings, return on invested capital, economic earnings or EVA or whatever you want to call it, free cash flow. We do all of that better than has ever been done before with any kind of scale by any other research firm. I'm not here to say that I can do it better than Warren Buffett because I haven't seen his models. But I would be surprised if he does it better than we do, to be honest with you. Because I found that over the years, the machines are just better at this stuff. They don't get tired. They're relentless. And as long as you tell them exactly what to do correctly, they're going to do it correctly.
Right. So David, just so people get a better sense of what you're talking about. So you're looking at footnotes. So what are you doing? Things like accruals and restatements. Like what's those? Just walk us through briefly. Like not too dorky about it, but just what sorts of things are you looking at? Give us some idea. Maybe you could outline briefly.
The big thing is like unusual gains that are buried in the footnotes, MD&A. You can't find on the income statement. So it could be gain on the sale of an asset, or gain on, an unusual gain from the sale of securities. And that's something that can cause the reported number to be meaningfully overstated than the real number because they're hiding unusual non-recurring income on the income statement that you don't see,
Right.
you don't pull out.
Right. So David, I remember, for instance, back in the day, one of the old tricks. I don't know if they still do it, but you like acquisition accounting. They would set up these they write up the value of the assets, they put these reserves in there, and then they wind up, instead of going through the income statement, capex and stuff gets taken out of there, all kinds of tricks. And you remember the quote, David. I forget where it came from. I think it was from maybe in 100 years ago, from some British guy. It was like, quote, the banker watch cash flow. Cash don't lie, earning statements do. Or the other line that David, what was we talking about before? Liars figure, but figures don't lie.
Yeah.
So it's like, David, did you have to mess up our good narrative, our good story with those damn nuisance numbers? Like, you're no fun. So, David, could you speak to the performance a little bit? And for everyone, it's up in the nest, because uh, it's great. I think most people get what you're talking about in terms of the concept. But I put up the three performance. Well, a few things. One, before that, you have your ranked number one by some zero for 46 months or whatever. But then you have three different performance graphs in here, and I think they're all kind of saying the same thing. But you've got the new constructs 500 compared to the S&P. And for everyone who can't read the fine print, it shows that over 5 years, beat the S&P by 33%, which is no small feat given how it became such a difficult index to beat. Your new constructs in 500 index was up 128. The S&P was up 95. And then you have something called the new constructs VA-1. You'll explain this in a second. I think this is very attractive stocks. So the core was 120, S&P up 95. The very attractive stocks up 175 versus S&P up 95. Those are the stocks that are you coded, I guess, to be most attractive. And then you have the core earnings leaders list, which was beat the market by 43%, was up 138 versus up 95. So, David, I mean, these are incredible numbers. This would put you like in the top 1% of all money managers, if one was managing a portfolio. Could you just explain a little bit about I'm curious, what's the difference between these three indices and how often do they rebalance?
They rebalance quarterly, and I'll explain what each one of them is for you right now. The new constructs ratings total return index that you pointed out, that holds all of our very attractive stocks. So we have a rating system. We cover 3,300 stocks. Eventually, we're going to cover every stock in the world. We cover another 7,000 or so ETFs and mutual funds. And we have a rating system that focuses on quality of earnings and valuation. And it's a very straightforward measure of how, hey, are the accounting earnings lying? That's always a bad thing. Are the economic earnings good? We look at return on invested capital, and we look at a few other valuation metrics, including a reverse discounted cash flow modeling grade. And the point is that the very attractive stocks as a group, when you put them in an index and track them over the last 5 years, as you point out, they outperform extremely well. And there's another Harvard Business School paper actually that showed that our rating system in general outperformed Wall Street ratings. Now, you and I both know that's not a high bar, but it's a rating system that I think is unique to the world. No one else has anything like this. That's reliable and accessible for all investors. I mean, we've got subscriptions on our site as low as $10 a month for some of our ETF research, $49 a month for access to ratings on 10,000 plus stocks, ETFs, and mutual funds. I'm not here to put this stuff in an ivory tower or only make it available to Wall Street insiders. I'm here for the opposite. And the very attractive stocks index, that's what I like to call it, is a great example of how good our ratings are. Pure and simple, these ratings do extremely well. If you have access to the very attractive stocks, you've got access to alpha.
So yeah, so David, let me just interrupt. So the new constructs 500, just I mean, it's probably, well, I'm getting in the weeds here a little bit, but what's the difference between the new constructs 500 and the new constructs rating very attractive list? What's the difference between those two?
Yeah, so they're very different actually. The new Constructs 500 is like an enhanced version of the S&P 500.
Okay.
So I love this is my joke on this one is that listen, I don't even have to pick the stocks. We can let someone else pick the stocks. In this case, the S&P 500, and we'll still outperform because instead of weighting those stocks based on market cap, as is effectively done by the S&P 500, we weight the holdings based on core earnings.
Ah,
That's simple. And just by reweighting the same stocks, we outperform significantly.
that's unbelievable. Something as simple as that, weighting them by the earnings. Oh my gosh.
And I mean, it's pretty intuitive too,
Yeah,
George,
yeah,
right?
yeah,
Like,
yeah, David. So I was going to say, like, it's just a hypothetical. We'll get to it later because no convo with you would be complete without referring to the electric car company that shall not be named. But let's just say hypothetically, okay, you had a company selling on 100 times earnings, just hypothetically, okay, and it was 2% of the index, 3% of the index of the S&P. Because you're weighting it by the earnings, it wouldn't be 3% of the index. It would be like whatever 30 basis points or something. Do I understand you correctly?
that's right.
Okay, okay, so wow, because like that's really interesting, Dave. Because people always talk about, well, the S&P is an actively managed index, and it's a momentum index, really, and blah blah blah. And it sounds good, but maybe a lot of people don't realize what that means. But when you just explain what you do, it's like you're not ignoring valuation. You're sorry. You're not weighting by valuation, by market cap, and you're not equal weighting. You're not equal weighting. This is not the RSP. You're weighting by earnings. Like that is so disarmingly simple, so intuitive. But like I've not heard anyone ever say that before. How did you come up with such a simple but crazy elegant idea?
I mean, to me, it always felt like if when we were running a hedge fund, that's sort of how we ran our hedge fund. We I think you should put more money in companies that have high quality earnings than you should just based on market cap. So I mean, to me, it was intuitive, George. To be honest with you, like if
Yeah,
I'm going to
no,
pick
no,
stocks,
100%. Just no one else thought to do that. Okay, so that's the 500, and then the very attractive ones. You just taken like the best 10% or 20% or something. What is that?
so our rating system is a 5 point scale. You've
Yeah,
got very attractive, attractive, neutral, unattractive, and very unattractive. And around 4% of all the companies we cover get a very attractive rating.
got it.
And so it's just a rating system that literally I set up,
Okay,
15, 20 years ago
right.
that I thought would be a smart way to think about stocks. It focuses on fundamental risk reward.
So this is the best. This is the best of the best. Got it. Okay, and just for everyone not paying, just to follow along, if you're not looking at the numbers, the one which weights just simple by the earnings, you're turning your brain off, just letting the computer do it. You beat the market by 33%. This very attractive one, you beat the market by 80%. And then what's the other one? The core earnings leader. What is that? That beat by 43%.
That's just a fund that holds the stocks that have the strongest earnings quality.
Got it.
So
Okay.
we look at the difference between core earnings and reported net income and divide by assets.
Got it. All right. That makes it. This is so simple. I love it because you don't have to get really crazy to be a rocket scientist to understand what you're doing. Okay. So you got these indices out there, Bloomberg, they've licensed or whatever. So are some managers, like, do you think, running money based off of these indices?
I would hope so. I'm not allowed to talk. I'm not a registered investment
Sure.
advisor, but one of these indices has been licensed
Uh huh.
by a major ETF issuer.
So there is so people can figure it out. I'll tweet it out later. But there is an ETF that you believe is being run along this. Got it. Okay, so that
Yes,
makes a lot
there
of
is.
sense. That makes a lot. And you said it rebalances quarterly. So over the last 5 years, let's say, or over a period of time you want to refer to, typically, how much of the turnover is there? Like, one thing that I've noticed and you know this, David, well-run companies, I mean, the earnings streams, it's not a random number generator. There tends to be positive serial correlation. And so I could imagine that some of the stocks in your models you held for a very long period of time. Other ones where there's a red flag because some crazy accounting note came up, out it goes. But sort of on average or range, like what's the sort of turnover that this strategy has?
It's medium, right? I mean, some quarters more than others, and some sort of economic cycles more than others. If there's a lot of sort of earnings, sort of
Right,
volatility, we're going to see more issues. Like I think these days, I think we're going to see probably a fair amount of turnover because I think you're going to see a lot of what I call earnings distortion,
right,
and that's those unusual gains and losses for the write down of inventory obsolescence,
sure.
or reevaluation of the pension fund, or off balance sheet debt. These are the kinds of things that cause the reported numbers to not well to misrepresent the real numbers, and that stuff tends to come out more in bad times than good times.
Right. So, David, I know you're not investing according to narratives. You're letting the numbers do the talking and the walking. But when you look at what you have created in terms of the portfolio, if you were just to look at the portfolio, how does it speak to you now in terms of the bets that it's making from the bottom up, be it balance sheet strength, price momentum, high quality, whatever? Are there any sort of summary comments you could make, and how does this compare to say what it's looked like at other times?
The very attractive stocks index. Those are very attractive stocks. Those are going to look good. Those are going to have great balance sheets. We have credit ratings too, so the credit rating is going to be solid on a very attractive stock. Almost always, I think it's very difficult for a stock to get a very attractive rating if the credit rating isn't going to be really good as well.
Hmm.
And the unifying characteristics for very attractive rated stocks is that they have really great quality of earnings. Economic earnings are positive and rising. They got high return on invested capital, and they got a cheap valuation. And oftentimes the valuations imply that the profits are going to decline, not rise by a bajillion percent like
Sure.
a yet to be an unnamed car company.
Right. So, and does this sort of the when you look at the bets that wind up being made bottom up, can you observe over time rotations to, the way the model works? It might be favoring one sector over another. Like I'm just going to spitball with you. I could imagine, I don't know if this is true, but given that you're weighting by earnings and given the incredible premium valuation that some of the Mag 7 achieved, not just the electric car company that shall not be named, that relative to the benchmark, your model was underweight, um, Mag 7, but nevertheless, relative to the S&P, but nevertheless, you absolutely killed it. But over time, do you find that okay, before tech went totally crazy, because tech earnings were accelerating? Let's be fair. I mean, yeah, the Max 7 went to crazy valuation levels, but you look back, David. I know you know all this, but you look back over 10 or 15 years. There's a good reason why they outperformed. It wasn't just expanding valuations; their earnings went through the roof, and these truths we hold to be self-evident. But you look at a graph of the 493, a chart of the 493. Forget about price. Just look at the earnings. There's a reason those stocks suck because the earnings didn't really grow. So when you look at bets that the portfolio winds up making, be it a sector, a factor, a style, can you sometimes glean interesting, observations from what the portfolio is saying?
I mean, we liked a lot of the Max 7, over the years. I mean, we were one of the first to write up Nvidia, 57 cents a share, split adjusted,
Wow.
as a great stock.
Right.
The difference is that we let it go before it gets crazy expensive. And I believe that the core earnings leaders index holds some Mag 7 and not others, and has held them at different times.
Sure.
And I know that the very attractive stocks index does not hold any Mag 7.
Right.
However they're doing it, they're still outperforming.
I
And
understand.
by the way, it's not just 5 years, but year to date, 1 year
Yep.
outperform as well.
All right. So, David, let's move to a couple examples, and then I want to work some of the audience into this. If you have a question for David, please raise your hand. Motorhead, I don't know what time zone you're in, but if you want to raise your hand and talk about a certain car company that shall not be named, that'd be great. So, David, could you start off maybe with a stock that give us people example of a stock that you like, and I'm gonna let Motorhead talk about the electric car company. So, Dave, give us an example of a stock that you happen to like right now.
There's quite a few. I was just actually on Schwab recently talking about 3 stocks that we thought were tariff proof, and one of those I love is my favorite because I love to say people got to eat. Kroger. Kroger's meaningfully outperformed this year, and the stock is still cheap, and we like it. We think this is a great business that's going to be tariff resistant. In fact, we're going to think a lot of people are probably downshifting from eating out to buying groceries and cooking, and stock doesn't capture any of that upside right now.
Right. And usually, if you mention Kroger, people are going to be like, what's the catalyst? There's not enough sex, drugs, and rock and roll. Wake me up when it's over, blah, blah, blah. But this thing's just grinding it out, no?
That's right. That's right. And look, I'm not about sexy stock picks. I don't believe in that. Look, and I get why CNBC and the media and Wall Street wants to sell you on sexy because guess what? Sex sells, but it doesn't outperform.
Yeah. It's like, David, I'm sure you get these calls. I got one the other day. David, could you please come on today? Could you please talk about the Kroger earnings? It'd be like, no, do I have to? It's like they're trying to sell excitement. All right. Okay, so Kroger's one. Is there another one you want to mention on the long side? And then I think Motor has a question about an electric car company. Is there another long idea that you mentioned on
Yeah,
the
and,
phone?
another one we like is Allstate. That's
Allstate.
another stock. People still got to buy insurance.
Right. Right.
And one of the things we love about this stock is that it's trading as if its profits will permanently decline by 20%.
Interesting. By the way, David, is price momentum or relative price one of the things that goes in your model or not?
It is not.
Interesting. That's so antithetical to the way most people roll right now. That's amazing. Okay, so Motorhead, I don't know where you are, but Motorhead, you were messaging me before. There's some electric car company you wanted to ask David about. I'm not sure I've heard of this company before, but Motorhead, do you want to ask David the question?
Yeah, David. Very interesting listening to you, and when you were talking about the guy, the investment banker, the tech banker who moved to Credit Suisse. I was actually at Morgan Stanley, like when he was still there before he left. So, but
Nice. Motorhead,
yeah.
by the way, I'm honored, flattered to meet you. I've been a big fan for a long time, so this is a cool moment for me.
Oh wow, same here. I really appreciate
Okay,
it.
so
Uh,
hold on, David. I got the ground rules here. Okay, Motorhead is a fabulous analyst. He's my go-to guy on this company. So Motorhead, he also does numbers too. He's not just a story narrative guy. So David, I want you like we can let Motorhead tell the story in the narrative, but Motorhead, let's focus on the numbers. David, you want to Motorhead? You want to ask David about the numbers? What is it about the numbers? I mean, I don't know. I'll let you have at it, Motorhead.
well, I just wanted to know, David, if you've ever how do your models evaluate, something like Tesla?
I mean, for me, it's always been very straightforward math.
Right.
That's what my clients like to. I love it when they write up in our community, logic driven analysis. And so for me, it's been an easy call. I mean, what we do is we call it's called the technique is called reverse discounted cash flow modeling. And that's a fancy nerdy way to say that we start with the stock price and we figure out what the cash flows have to be to justify that in a regular discounted cash flow model.
Okay.
And this cash flow model is very different from others, though, because it's not based on a fixed time frame. So if I got to go out 25 years or 30 years to get to a price that makes sense, well, then, that's what I do.
Right.
And then I look back and I say, for example, with Tesla, when it was at around $250 a shares, when we just recently published a piece titled "Pipe Dreams Are Made of These." Little play on the
Yeah,
Eurythmics
and
song.
by the way, it's I think it's in the nest as well, David, so people can see it and they tweet it out. Keep going.
Yeah, it's free. It's a free report. So what we do is we go in and we'll say like, all right, to justify $250 a share, our model shows that Tesla would have to improve their net operating profit after tax margin to
Right.
15%. Guess what? It's only 5% right now.
Huh.
And Toyota is 10, right? So we're going to give them the best margin of any car company in the history of the world. And they're going to have to grow revenue at the same time by 28% compounded annually for the next 11 years.
Wow.
So the margin gets jacked up. The revenue is at 28% compounded annually for 11 years.
Jesus.
And then so we say, okay, well, that means 1.4 trillion in revenue in 2035, which, by the way, is 130% of the combined trailing 12 months
Wait, wait,
revenues of
wait,
all the
wait,
major.
wait, wait, wait. Breaking. Motorhead. Tesla revenues are falling. What were their revenues last year? Like 110 billion or something? And what are you going for this year,
Yeah.
Motorhead?
Yeah, I've got it's like something like gosh.
They're not. They're going to be under 100 billion this year, won't they? Something.
Oh yeah,
Yeah.
I've got 86 billion, so 12%
86.
decline. Yeah.
86. You nasty
Yeah.
boy, you. So I just want everyone to understand this. David said, David, so 86 billion. David, repeat that again for the record. Under oath, raise your right hand. You said it's got to go to 1.4 trillion by 2035. Is that what you said, David?
Yeah. And by the way, if you made the margin lower, it'd have to go even higher.
Yeah.
Oh boy.
So here's the fun part. Here's the fun part on all this is that we'll say, okay, let's assume that the company's like only 80% of the business is automotive revenue. So we can get the implied automotive revenue in 2035, 1.1 trillion. And we can divide that by different average selling prices to get to the number of cars that they got to be selling at that point in time to justify the price. And then we can look at that number of cars as a percentage of the expected entire electric vehicle market. And that's where the numbers get really dumb.
David,
Because if you,
David, I think you and Motorhead got to get a room somewhere together. I sense an emerging bromance here. So Motorhead, I'm going to yield to you. Why don't you pepper David with the next question? I don't want to take away your fun.
No. And also, how would you? I mean, there are a lot of investors who are big fans of the Holt thing that was at Credit Suisse, and you were mentioning that your system is like sort of more advanced. Like how is your system different from the Holt stuff that Credit Suisse was using?
Yeah, I got a lot of respect for the Holt product, but we were very intentionally different from the Holt product before Credit Suisse bought them. The difference being that all of our models were based on the real data from the filings and not CompuStat. So CompuStat is probably the oldest and most widely used financial data feed.
Right.
It's replete with a lot of errors. And so, but the beauty of that database is that, it's like works and it's normalized for every company like around the world. So if you've got a model like Holt does, you can immediately be in business covering every company around the world if you sign up and use CompuStat. The downside is that the quality of data is very poor.
Okay.
And Harvard Business School, in fact, directly compared our data to CompuStat and found and wrote a paper proving that our data is significantly better than that CompuStat data.
Wow. Interesting.
And so New Constructs is designed to employ all the same concepts as Holt. Like no one disagrees, that do this kind of work. No one disagrees around the benefits of return on invested capital or cash flow return on investment. I mean, these are better metrics. I don't know if anybody would argue, like when it comes to fundamentals, that return on invested capital is a bad metric. The key is what kind of data goes into measuring it.
Right. Yeah, that's a good point. And does it? Holt. The people who really love Holt are generally value people, and I'm just wondering, how does your system work? Like depending on the mood of the market. I mean, for the past 2 years, it's been like nothing but the Mag 7. And you mentioned that you actually got into Nvidia when it was really cheap. How does that work? Like with the the market timing and the mood of the market.
Yeah, I like to joke that the Market Timers Hall of Fame has no one in it. And so,
Hey, Rusty, I hope you're taking notes, man. This is like greatest hits. This guy's almost as good as the BCA guy.
I'm in hog heaven, man.
Yeah, keep going, David. Keep going, David. You're at it. You got the floor. Go for it.
And so I'm really not trying to time the market. I don't believe in trying to predict the day-to-day psychology of the market. I think that's a tough thing to do. Now, look, if I had a big hedge fund and enough money to pay for order flow from everybody in the market, well then yeah, I might be willing to try to time the market then, because seeing what the market's going to do before it does it, that's a nice advantage to have. But absent that kind of front running capability, I'm going to focus on what I can control, and that's risk reward. In a world where I cannot predict the future, I'm going to control what I can control. And that's the risk reward of every single stock that I make an investment in. And that's exactly what our rating system focuses on. Our very attractive stocks have excellent risk reward. Our very unattractive stocks have the worst risk reward.
Wow.
And that risk reward is simply quality of earnings compared to valuation, right? A very attractive stock is going to have super high quality of earnings, strong economic earnings growth, but a valuation that implies there will be no earnings growth.
Right.
And that's where we see disconnects. And that's part of why you see our strategies outperform the market. I shared with George the 5-year performance, but if you look at the last year, you look at the year to date, outperforms then as well. Are there going to be periods of time when they don't outperform? Probably yes. Because
Right.
when the junk is just running, when Carvana's shooting up
Yeah.
to
All
200.
right. Okay. Yeah. So, David, I got to call you. I got to stop this. I got to call you about this. So, David, I'm blown away by the numbers because this occurred at a time when it was so hard to beat the market. Let's say the forget about 25. We're talking about 24 and before, going backwards. Did I see correctly in one of the things you put? I don't know if it was a typo or not. I got to ask you. In one of the charts you sent me, did you guys at one point actually, and I'm not saying this to attack you, but to support your methodology, did I see GME listed somewhere in one of the things? Did you guys have that as a long at some point?
Oh yeah.
Oh, yeah. Oh, yeah. Like
Oh,
we were
Dilly,
long
hold on. I
as
know
a.
you're gonna get hot now, but yeah. So David, this just blows my mind. So here it is. You're trying to be Mr. Fiduciary, Mr. in the footnotes. I'm a nerd. I'm not following stories. Blah 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 blah. And I look at this thing, and holy smokes, there's GME. So that wasn't a typo. How did GME get into your thing?
We liked GME in early 20. We first wrote on it in 2018.
What?
Yeah, because it was trading at a price, and so did Michael Berry, by the
He
way.
he did. Yeah, I looked it up on the while you guys were
Oh
talking.
God, you show.
Yeah, and Dilly,
Dude, I'm
feel
doing
free
my
to put.
research for you, George. I'm here in the back end, in the
Yeah,
back
and
channels,
Dilly,
doing the research, getting the show running. Yes,
thank you, Dilly,
Okay.
and feel free to share those links to those reports.
I'm sharing them for you, David.
Yeah,
Yeah, great.
Dilly is doing this as a public service, right, Dilly? No, no,
Yeah,
no
something like that.
self-interest. Yeah, you're putting yourself out there for our peeps. All right, go on, keep going.
So yeah, I mean, but then we closed the position in January, late January, because it got too expensive.
When it went to the moon, that crazy.
Yeah, we were
Yeah.
like, oh my god, and it
What
was.
price did you exit it at, if I can ask?
Let's see,
This was 2021,
It
wasn't
was
it?
in January. I saw the
Yeah,
January
yeah,
2021. We
January
exited
20,
it.
2021. Yeah.
Yeah, we wrote. You can see the precision close update report on our site, January 28, 2021. I think the stock was at 197.
197,
Yeah,
and then it went, and it kept going up, and then it crashed. Oh my God.
yeah. And then like within a couple months, we were writing reports saying that was a terrible idea, right? Like we were like, this is
So
the.
so 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 Dave, I have a friend. She really likes GME. Like, what should I tell her? She wanted me to ask you the question. What should she do? She's kind of interested in GME. What should I tell her?
Uh, don't walk, run from that stock.
David, how can you say that? They have $4.8 billion cash on hand.
I mean, that's just a bigger pile of wood for them to set on fire.
I mean, I thought you were saying that
The fact that they've raised
you
that
like
money
cash
is
on the balance.
yeah, because they've been selling the stock to take advantage of unsuspecting investors in a business that I don't think is very good. I mean, this gets our very unattractive rating. The return on invested capital is 0 to negative.
Security.
Yeah.
Get this guy out. Security. Dilly, remember that? Remember that Burger King thing that hilarious skit where they call us. I'll show it to you later. All right. So Dave, you're just saying it's too expensive now. Is that what you're saying?
it's not a good business. It's a bad business.
All right, but if they were to become like if they could pull Michael Saylor Jr. or something like that, which is what the Bulls are expecting, that's a totally different story. I mean, I'm not in the name, but I mean, obviously the people that are in the name are believing something like that. But based on their existing legacy business, it's unattractive in your opinion.
Yeah, and I think if we run the reverse DCF on this company, we would see that the expectations for future cash flows are extraordinarily high for whatever business they might get into.
Okay, so I'm gonna turn the arguments on its head. Okay, so I remember being I'm raising my hand. I'm going to confessional. I remember a few years back being negative on MicroStrategy because it was quote unquote overvalued, and you know all I gotta do forget about whether it's overvalued right now. Of course it is, but I'll probably eat those words. But the stock went to the moon. Clearly, people, most the market didn't fully comprehend what was about to happen, and also other than the Bitcoin, evangelicals, most people didn't think Bitcoin was going to do what it did, and so the stock was a huge stock. So it's okay, David. It's me. You can tell the truth. I was bearish on MicroStrategy way back when. I'm going to imagine that your model, 3-4 years ago, probably had MicroStrategy as an unattractive stock. Am I right?
Yeah, let me check here. I mean, we've written on MicroStrategy here recently.
Yeah, because look, and again, it's your system. That's another thing too. I just while you're looking at that, I'm just gonna go get on my high horse here. We're in a business. We all know this. Where if you're right 60% of the time, you're an all-star. And one of the things I can't stand about X is people getting on someone's case because they're wrong on a stock, or they could have even been right on the stock, but their time frame is different from your time frame. And so, I mean, imagine in baseball, think about it. In baseball, if you make an out 70% of the time, you could make, 30, 40 million bucks a year, 300 hitter. So if we're going to ridicule, a batter who's, hits 350, because he's a schmuck, he just struck out. I mean, that's like sheer idiocy. But there's so many knuckleheads on Twitter that do that. It just blows my mind. So, yeah, I was wrong on MicroStrategy. You want to make something of it? Last I checked, that's a misdemeanor, not a felony. So, David, from where you sit, like, what did your model? I'm guessing because your model's common sense, it probably had MicroStrategy as being unattractive. I'm going to guess it's also probably still got as being unattractive. But the floor is yours, David. You're muffled again. Sorry.
So yeah, no, it's been unattractive. I just checked in the system. It's been unattractive. I'm going back to 2020 is what we're showing here.
Right.
Very unattractive for a part of that time as well. Yeah, no, this is. I wrote a report on MicroStrategy called "Hope is not a strategy." And yeah, I mean, it really just goes through the ridiculousness.
Yeah,
Of the
well,
whole
and that, and again, David, you know this. We all know this is not. This. There's no foolproof method. You really got to trust the system. It's the way of the evidence, and so again, one of the things that people just do on Twitter all the time, they pick on somebody because they were wrong on a stock. So what? That comes with the territory. So whatever. So I imagine it's probably still got MicroStrategy being unattractive. All right, whatever. I mean, to each their own. It is what it is. But your track record is really quite enviable. So more power to you, my friend. Rusty, do you have a question? Because Rusty, you're a fundamental analyst at heart, and I know you were messaging me like, wow, this is really good stuff. So, Rusty, the floor is yours. You got a question for David?
Yeah, David, I've been loving it. But so can you because I kind of put in the comments disclosures. You were saying it goes into your model. I was kind of curious how so you take did you say AI and you're ripping out those and quantifying them in some way? Is that what you were saying?
Yes, the ones that can be quantified. I mean, we're not doing sort of sentiment analysis on tone or words. It's all footnotes and disclosures that provide specific numbers. Like the pension disclosure, the options disclosure, the not yet commenced leases disclosure, the restructuring disclosures, foreign currency translation disclosures. There's actually a page on my website that lists 20, 30 plus accounting loopholes, and I have a white paper for everyone to see
So,
that
David,
explains all these loopholes.
yeah, so
Sir?
Dave, while you're looking for that, just off the top of my head, I know, for instance, I'm just curious if your system does this. So companies, when they change, to just tease out a little bit more from you, you talked about so like, for instance, when they change the assumed return rate on their pension plan assets, so they can decrease, they assume a higher forward rate of return on the pension assets, so they can decrease the amount of contribution they have to make, or they change the estimate for depreciable life for an asset. Oh, it's going to last 40 years now instead of 30 years. Things like that. I mean, those are the sorts of things that go into your analysis.
Yeah, we've written articles in particular on this expected return on plan assets. I even took some of those to the SEC.
Really?
And took a bunch of stuff to the SEC. Balance sheets that didn't balance, income statements that didn't add up, just to say, hey, listen, we got a technology that can free your people up from having to do this work, which, by the way, they're not doing so well anyway, but, or maybe they're not doing, so that you can, work more efficiently.
All right.
And
Okay. What about the scam that is adjusted earnings, which the whole stock based compensation and percentage? The worst offenders are the ones who they tend to have the most aggressive accounting. These are the guys who oftentimes have to raise money, whatever. But to me, the whole stock based compensation thing is a complete scam. I mean, do you want to speak on that at all, David?
Yeah, no, we've been doing analysis on that. I mean, I think the best paper or research written on that was with Bob Heiler and Michael Mauboussin, and they published it at Credit Suisse, um, and you can find it under the Frontiers of Finance. And basically, what we've been doing since before option expense was reported on the income statement is modeling that expense. So if you go back and look at VeriSign, and our model goes back to 1998, I don't think they were required to even put option expense on the income statement. And we saw this for a lot of companies. We did it. Actually, there's a special article that Fortune magazine did on our research, because anyway, first of all, the unreported option expenses were often 2 or 3%, 200% of revenue. Now, when that
What?
stuff,
What?
well, that's yes, when that stuff got moved into the light of day, and they were going to have to start putting on the income statement, well, they play some tricks. This is what Fortune pointed out, and it's called the volatile brew. Because what they would do is they would dramatically lower the volatility assumption in the Black and Scholes model, so that reported option expense on the income statement could be a lot lower. And the funny part about the article is that they made up like all these ridiculous reasons because they knew nobody was reading the filings as justification for this unusually low volatility expense. And I'm sorry for nerding out.
Right.
The takeaway is
Yep.
these companies were admitting they were cooking the books or manipulating the numbers so that they could understate their expenses for decades now, and you don't hear anything about this.
Yeah. So let me just explain for a second, David. You correct me if I got it wrong here, but just so for the average person in the room that maybe is not in the doesn't appreciate your nerd dome as much as I do. Um, so what David's talking about, stock based compensation, just to translate into plain English. So let's imagine, Rusty goes to work as an engineer at Tesla, and they'd have to pay Randy, I don't know, $300,000 cash if it was normal. But instead, Rusty agrees to work for $150,000 instead of 300, and they give him a bunch of stock options to in lieu of the 150,000 cash that he's leaving on the table. And so what these companies were doing, they would report the 150,000 cash expense, and before the options accounting stuff got put in, they'd say, "Oh, okay." But what they're forced to do under the I forget which the accounting body is, David. But what they're forced to do is to ascribe some value to those options, $150,000 worth of options. I mean, obviously, Rusty thought it was worth 150,000 because if he didn't, he would have gone to work for somebody else for $300,000. So it really is an expense. I mean, they paid him 150 cash instead of 300, and the reason they could get away with this is they gave him options in place of it. And so this looks great. And so what happens is, you can imagine, and David, you probably know the numbers better than I, but the number of millionaires that are in NVIDIA now, I can't remember, it's like 1 in every 10 employees or something crazy like that. This is a real expense. This is a real expense. And what the companies will have you do, they come out with adjusted earnings, non-GAAP. And I know it's not just stock-based compensation, it's excluded. There's other nonsense that goes on as well, but this is probably one of the biggest items. And so when you see earnings announced, especially David, and I'm sorry to talk so much, but I'm trying to give context to your remarks, make it easier for you. You see announced earnings, they're quite often not GAAP earnings or non-GAAP earnings. So they're including all the bad stuff. Or the other one I love too is EBITDA. Earnings before interest, taxes, earnings before interest, before taxes, depreciation, amortization. So basically, as Warren Buffett says, it's earnings before all the, I forget what he calls it, but whatever. It's a complete and total scam, but it doesn't serve the cause of the corporations or the investment bankers. So, David, I don't know what part of that you want to criticize or elaborate on, but I think the gist of it's basically correct. No?
Yeah, that's basically it. I mean, and for a long time, especially during the internet bubble, the companies used this as a way to pay people a lot of value and money without having to report on the income statement.
Exactly. And
What
yep, go
wasn't
ahead. Keep going, David. Keep going.
And that's always the
David?
game,
Wasn't this
folks. That's
Facebook that started the restricted stock unit?
Rusty, what was the question again? I'm sorry.
It was Facebook who started this restricted
This was well
stock
before
unit.
Facebook went public, my friend.
Yeah.
We're talking the 90s
Yeah.
and
This
early
is
2000s.
I'm talking about the
Yeah,
RSUs.
Russ, that's something
Okay, I'm
different. But this is in the '90s. Listen, these scams they keep coming back under different names. So it's it's just a different shade of gray. That's all. So yeah, I mean this is so they play all these games. And Dave, what really pisses me off, and you were kind of getting hot a little bit early in the conversation, which I like because we think the same way. And you were talking about accounting systems, or I forget the terminology exactly used, but these management teams it's almost like they viewed the accounting systems as an obstacle course. Like, how can we camouflage what's really going on without violating FSB requirements? I mean, it's just absurd. I mean, it's not a coincidence. Some of this is just pure unadulterated theft. I mean, how else would you? I mean, it's insane. I remember. I know you know this, David, but for those of you that in the room that don't know this, the Andy Fastow, who was the CFO of Enron, reporting to Jeff Skilling, the treasurer. I remember being short Enron when it blew up. I also remember, about 10 years ago, 8 years ago, whatever. Fastow got out of prison because he went and he served time. This is a great story, Dilly. You love my stories. Fastow got out of prison, and he went on the talking circuit, and he was pretty contrite about what had happened. He wasn't like trying to claim he was innocent or anything like that. And it was really interesting. He goes, I was brought up to do things the right way, and I never thought I'd be in this situation. He goes, let me show you two front pages, and I think it's from like the New York Times or some magazine. One was like 1999 when he was voted, and David, maybe you were, I don't know where you were when this went down. I should remember it. He was voted like CFO of the year because like value creation and all this wonderful stuff. And then he showed like the front cover of the New York Times or whatever, and it was the headline, for the business section, Fastow, convicted of fraud, whatever. And he's like, this is how he started out his speech. It was really powerful. He goes, look, it's the same guy. How did this happen? How did I go from being this guy, CFO of the year, to that guy? And he explained how at Enron, this is a true story. He explained at Enron how it was part of the culture, and the reward system was set up to encourage this type of malfeasance. And no kidding, no kidding. He said there were two sets of books. There was one set of books, let's call that Exhibit A, and then there was Exhibit B. And basically, what he would do by recharacterizing certain things, it's like when you go to the eye doctor, Dilly, do you like it better this way or that way? And so he was encouraged to do this. The board, as they go to board meetings and show him all this stuff, and the culture, his stock options, his compensation, it was a way of life at Enron. And so I don't know what part of that, David, you find that you've heard before, or you want to embellish or reject to, but I was just blown away listening to Fast Al tell the story.
I mean, my favorite story is the fact that the accounting department within Enron was the largest single department. And that accounting department's job was to do one thing and one thing only, and they knew it was bad because the title of their handbook was, "We focus on producing accounting earnings, even though accounting earnings don't represent the real profitability of the business. They're what executive compensation is based on.
Yes,
So that's what we're trying to make look good."
yes, yes,
That's a quote. That's a
yes.
quote.
And David, you're going to crack up, but back in the day in Dilly, I'm much of a DJ, and you could imagine this. So back in the day, in the early OOs, in the wake of bank or whatever it was, no, it would have been around 2010, I think. Trying to remember exactly when this happened. No, it happened over a number of years. So you could buy swag, all this corporate memorabilia stuff on eBay, and I had too much time on my hands. So I was going around. I bought up a lot of this stuff. I actually had the Enron E. I can tell you guys about it. If someone wants to ask me later, I'll explain how I got it. But I actually I still have, a few copies of the Enron Code of Ethics, and priceless. But it's exactly what you say, David. Just incredible. And as you said, the whole culture was set up for that. So I mean, just insane.
Well, they had Arthur Anderson just
Oh
signing
yeah,
off on it left and right too.
I have Arthur Anderson memorabilia here too. I got WorldCom. I got it all. So yeah, I mean, listen, so Rusty, you're a little bit younger than I am, a lot younger than I am, fortunately. But you're talking about the RSUs with Facebook. I mean, like Dave was talking, a lot of this crap. I mean, has been going on for decades. You had an acquisition accounting. David can speak to this, but if David Trainer Industries buys, Motorhead Industries at three times its book value or last price, whatever, Trainer Industries will write up the value of Motorhead Industries and set up reserves, and then they'll show and again, this goes through the balance sheet, not the income statement. So a lot of stuff which subsequently should have gone through the income statement and depressed earnings per share never goes through the income statement. It can't get taken out of the reserves that they establish in their acquisition of Motorhead Industries. So all this acquisition, and David, I mean, this is not exactly what you do, but I'm sure you can speak to it, but it's another one of my pet peeves. M&A, oh, M&A, M&A, M&A. I mean, companies that do M&A, the amount of wealth destruction. I mean, because the bankers love it because they're making commissions on these acquisitions. But David, could you speak to merger accounting and just the wealth destruction that tends to occur in M&A, David?
Yeah, no. Well, my favorites are the.
Can you guys hear me?
Yeah,
Yeah,
we've got a
sorry,
fat finger.
I hit a button by accident. David, rewind 5 seconds. I hit a button by mistake. Go ahead. Dilly, can you hear me?
Yeah, David, you have to unmute
David,
yourself.
unmute
George muted
yourself.
you.
Unmute yourself, David. We can't
This
hear you.
time he didn't mean to mute you. Last time he did.
David, we can't hear you. Complete.
That's what happens when you talk for too long, George.
Yeah, I understand. But and the problem is,
You're back,
as I've been
David.
reliably informed, I like to talk a lot. But go ahead.
Yeah. So my favorite accounting trick with respect to mergers are the contingency reserves, and these are a bona fide true way to completely manage earnings. The contingency reserve is something they set up in an acquisition that is typically based on earnouts kind of idea, where hey, we're going to pay you a certain amount if the company does a certain depending on the performance of the company. And those reserves get added to and reversed from in ways to manage earnings very directly. It's just reserves are one particular uh, accounting loophole that require a lot of adjustment. But that's my favorite. There's another great report that if you haven't seen it, it's called "Let's Make a Deal." It's written by Mobison and Bob Heiler as well, and it goes through exactly how companies can acquire other companies, destroy huge amounts of value while making the earnings go up. So as long as a high PE company buys a lower PE company, its earnings accretive.
Yep.
It has nothing to do with the underlying economics.
Yep.
Zero.
Yep.
So we have to do all kinds of adjustments to fix acquisitions. One of the big loopholes that they did close, but is still, affects a lot of businesses was the pooling method of accounting, which is probably one of the dumbest accounting rules of all time.
Right.
The pooling method accounting allowed people to record the acquisition of another company, allowed companies to record the acquisition of the company it acquired based on that company's book value as opposed to the amount actually paid. Unbelievable. So let me put this to you. So let's take a company like NVIDIA, right? Its market cap is in the trillions.
Yeah, I think it's about 2 trillion. Yeah, go ahead.
Right. But the book value of that business is closer to, let me see here. I'm looking this up real
Maybe
fast.
100 billion or something like that. I'm guessing it's 20 times book or something. Go on.
I mean, the book value is going to be, like maybe 90.
Yeah, okay, not bad. 100 billion. Go on.
Right. So in the pooling method of accounting, if somebody used the pooling method of accounting to buy NVIDIA, they would only record the 90 billion of book value of equity on their balance sheet, as opposed to the trillions that they paid for
You
it.
serious?
Oh yeah, you never heard this pooling method of
I
accounting?
have,
Look it up.
but you know what? It's been so long since I studied for the CFA. I forget this detail. Go on.
I'm just joking with you,
I
George.
know. Go on.
I don't expect you to remember all the nerdy stuff that I remember. But yeah, no, I mean that's just an outrageous. And what people don't understand, look, I worked for FASB for 5 years on the investor advisory committee. And what people tend not to really quite understand is that the FASB people, they're not finance people, they're accounting people. And for decades, they were funded by corporate America. So who do you think that they cater to?
Exactly.
And I would, on a regular basis, voice my concern with the board about their tendency to cave to corporate requests. They would say, "Oh, the company says that's too much work to have to disclose."
You're no fun. You're a party pooper, Dave.
And I would say that's the most ridiculous thing I've ever heard.
Yeah.
Look, and this was about derivatives usually, right? Too much work for them to disclose what's going on with their derivative portfolio. And I said, listen, that's bogus. Like there's two situations going on here. Either number one, they've done the work and they know what's going on with their derivative portfolio, in which case it should not be a lot of work to share that with investors because investors deserve to know. Or number two, they didn't do the work and they don't know what's going on with the derivatives. And investors deserve to know that as well. Because I need to know if they haven't even done the work to understand what's going on with their own derivative portfolio. That means, is what Warren Buffett calls derivatives, financial weapons of mass destruction.
Oh my God.
The company could blow up. So I'm like, FASB people, like, you can't fall for this. This is so dumb. Makes no sense.
Yep.
Either they're doing the work and they know what's going on, in which case they can share it. Or they're not doing the work, in which case I need to know that even more.
All right, David, hold it there. You're getting like me. All right, let's go. Rusty, you have a quick follow up, and then I want to go to my good life. Rusty?
Yeah, you're like preaching to me. I'm loving this because I cleaned up a lot of CDS in Chicago, and the thing is I was blown away. I remember I was a young nerd coming in there, and I'm just like, again, sorry, George, sidebar real quick. I would rather see your collection of things like your Enron papers than to see Motorhead's collection of vehicles. Right, that's the stuff. I'm
You're
that
a
big of a
real
nerd.
perv, financial perv. All right, guys, go on.
Yeah. So anyway, the first thing I asked, I was like, okay, let's take a look here, guys. Where's all the audit reports? What do you have? What have the regulators been saying? They looked at me like I had like 8 heads. I was like, wait, where's it at? They're like, they're fine. They don't really have much. I'm like, where have they been? They didn't give us much guidance. They kind of let us just explain it ourselves. I was like, oh, this is going to be a long time. It was a mess. I was just blown away by that. So that was the first thing my boss told me. He's like, yeah, no, we really didn't have much oversight on it. I was
Oh
like, oh
man,
God,
that's crazy. Thanks for that, Rusty. Let's go to my good life. My good life, please unmute yourself. You got a question for David?
Yeah, so I really love math too, and one of the math problems that I'm trying to figure out is around our $37 trillion in debt as a country. I guess, have you done any sort of analysis on, there's quite a bit out there in terms of the growth rate that it's growing, and I'm just trying to, pick your brain a little bit in terms of what you think is the likely outcome of that growth, and how does that factor into your investment analysis going forward?
Yeah, I think what we're headed to a place where money's going to be more expensive, which means we're going to see a pinch on liquidity because we've had excessive amounts of liquidity for a long time. That's why stocks like Carvana and GameStop and the zombie stocks. That's why that's what created zombie stocks. There was too much money flowing around. Just like if you go to Vegas and you got $1,000 in your pocket, you're going to bet more than if you got $10 in your pocket. And so we flooded this market with excess liquidity, and we've got some pain to endure to wean ourselves off of it.
Well, I
And we
guess,
have to,
why
if we're
wouldn't
ever going to get that 37 billion trillion in debt under control, we can't just like at the Fed keep pouring money into the economy. We can't have fiscal stimulus all the time like we've had. So that's got to come out, and money's got to get more expensive, which is gonna be a hurt. But the problem that you point out here is not getting any smaller. We either take our medicine now and take less of it, or we just have to take more of it later. Or worst case scenario, we become so indebted to other countries, we end up like the UK,
Yeah.
which has zero industry, is entirely dependent on other countries, and could easily be taken over.
Yeah, no, that's fair. So my good luck. It's a good question, but I'd like not to go further into that subject because I think it's a great discussion, and we've talked about that a lot in other rooms. Happy to talk about it as well more, but it's not really David's area of expertise, even though I agree with his opinion. So let's try to keep it in the rails of what New Constructs does. Let's go over to HTS Maglev. HTS, please unmute yourself. You got a question for David? HTS, we can't hear you. I'm sorry. Now he's a listener.
He ran.
He ran. He got found out. Oh well. So David, what where can people find you if they want to learn more about what you do? You have a website?
Yeah, just go to newconstructs.com. I think I put a link to I got an earnings watch I'm doing tomorrow, free, where I'm just going to break down earnings on some of the biggest companies in the market.
Okay,
Uh, and that's a great way to get to just, I'll show you how the system works. I'll show you like
great.
the professional
So is
access.
there a link that in the website, or can you send it to me and I'll tweet it out or something?
Yeah, I put it into the chat here, I believe.
Okay. Dilly, can you post it in the nest? I don't know. I'm having problems on my screen right now, Dilly.
Yeah, I did post up in the nest his zombie stock list.
Right, but he's also talking about some earnings watch thing for tomorrow, I think. Is that what you're
Oh,
saying,
okay.
David?
Is there a specific link? I'll look for that.
I just put it into, I'm not sure how to.
Well, could you just tweet it out, David, and then Dilly will take it from there?
Yeah, I got it.
Okay, all right, cool.
Yep, I
I
found
put
it.
it into this
Yeah,
conversation
down
here.
below. I'll put it up in the nest for you.
All right, that's awesome. Wow, this is really, yeah. This has been magical, David. Seriously, I mean, you didn't get too much far down the rabbit hole, but so many spaces are so superficial, and I don't know. I learned a lot here today. I think I speak for everyone in this room, and I hope you'll consider coming back in. It was a lot of fun. And who knows where maybe today it's the electric car company, which everyone's the apple of everyone's eye, but who knows where we'll be 6 months from now. Hopefully we'll get you back before too long. But
Can I ask David a question before
yeah,
we go?
of course, Dilly, of course.
What do you think of Bitcoin, David?
I think Bitcoin is a symptom of overly liquid society, and it's probably going to come down a lot before it's all said and done. It's just a speculative vehicle that is unfortunately, I think, going to potentially hurt a lot of small investors' portfolios.
David, let me ask you a follow up. Do you this is totally speculation on your part. This gets away from the model and the recommendations, but do you have a market view?
Yeah, I think we're going to see the market. It's going to be it's going to be a tough 6 months.
Right.
I think that we're going to have to rebalance trade and cut our spending and as a country, and then get used to paying more for goods. I don't think it's a good idea for us to buy 15 pairs of pants and just throw 8 of them away every month. I don't think that's healthy, and I think we're going to have to kind of get back to some old school values.
Right. Yeah, no, I think it's going to be tough as well. Who knows? I mean, it's every day changes. I mean, Dilly, is everything up huge right now after hours? Like I haven't even been watching. And it's also one of the things, David, about these spaces. So many people trying to day trade and do God knows what. I look at the market 2 or 3 times a day. That's it. And as I like to say, the market has no institutional memory from one day to the next. I mean, it's up, down.
Yeah, if it's okay, guys, I got to
Yeah, no,
jump
for sure. We're gonna
to another
No
we're
call.
problem.
gonna
I'd love to
yeah,
do it
yeah,
again. Love to do it again.
Dilly, hang right here for a second. So, David, thank you very much.
Sure
You've
thing.
been more than generous with your time. We'll keep the space going just for a couple more minutes. Thank you, David. Have a good one.
Thank you.
Yeah,
My
yeah.
pleasure.
So, Dilly, wow, huh?
Yeah, the market is up a bit. Yeah, I would say that Microsoft is up 5.3%. So
Breaking.
breaking. Yeah, breaking news.
Yeah.
We had double beats.
Oh God. Well, as the saying goes, I keep invoking from Stan Weinstein. It's not the news; it's the reaction to the news. Buy hot.
I can't believe that you brought up GameStop, George. Like, look at you.
Well, no, I didn't bring it up, Dilly. Let me tell you what happened.
You brought it up. Run it back, George. You go
No, no,
listen to this space when we're done.
Dilly. Hold on,
George,
Dilly, hold.
it's recorded.
I know. It's a question to find you.
You brought GameStop into the
Okay,
conversation, not me, sir.
okay. You're pulling a George. Can I get a word in, please? Okay.
Yeah, you
All
can.
right. So the reason I brought it up was because the stuff he sent me, I was reading his reports. It featured on one of his pages as a buy, and I was like, "What the huh?" So that's why
Oh, it did?
excuse me, in David's stuff.
It did?
Yeah, it was in an older report. Yeah, GameStop as a buy. So I was like, how in God's name did you have it as a buy? Not as short. I read it like 3 times. I couldn't believe it.
Mm-hmm.
So anyway,
Yeah, no, he did have the 2018, and then it did seem it was also they called it out in 2022 being bearish, but they took it off their
well, look,
list.
he sold it at the right time. That was great. But, like you said before, I mean,
Mm-hmm.
when it brought the MicroStrategy to by comparison, I mean, look, he had it as a sell. It is a sell. I mean, it doesn't change because the way his model works, it's not going to pick up stuff like that. So it is what it is. So in other words,
Yeah,
if you're waiting for him to turn bullish on MicroStrategy, don't hold your breath. Ditto for GameStop because it
yeah.
looks at traditional valuation parameters. So, okay,
I think if you're waiting for anybody to be bullish on GameStop, you're going to be waiting a long time.
probably. So there's a couple things.
It's just me, guys.
Yeah, so let's open this a little bit more. We'll go for a few more minutes. A couple things I wanted to talk about. So Michael Kramer, who's not here today, did want to point out that there've been a lot of very enlarged, heightened options activity the last couple weeks, and a lot of call buying, in his opinion, on names going into earnings. And so it would seem that Microsoft and Meta, whatever, delivered the goods. Stocks are up a lot. But Michael points out that he would expect, and this could carry on for God knows how long, but he thinks to the extent the market was pumped up, or these stocks were call options were bought, they'll be sold shortly thereafter, maybe next couple days, and therefore he would look for weakness to follow. So it's the usual, buy high, sell low, ha ha ha, tongue in cheek. So he wanted me to pass that along in his absence. The kid to take his girls to dance lessons or God knows what. And then I'm going to say this gently, but I really, I'm sure he's a nice guy. And so if he's here, he's welcome to come up on stage. So I'm going to say this as a sort of learning experience, not as I'm throwing stones at this guy, but I have to, I just feel compelled to say this. So I tweeted out earlier today, let me see if I can find it as I'm going along. I tweeted out something about Tesla. I think Charlie Bolello had put up a chart. I'll put it up in the nest. Charlie Bolello Here we go. Let me just put this up in the nest right now so y'all can see it. I'm putting this up in the nest, and I'm putting this up in the nest, and I'm putting, yeah, okay. So I'm putting,
Oh, you did a how it started post.
yeah, okay. So if you guys look at the nest,
How it's going.
you'll see Elon Musk, a quote, not it's Elon Musk in
Mhm.
his own words. Elon Musk claimed in 2019, as recently as June of 23, that Tesla vehicles would appreciate in value due to their potential for FSD, blah, 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 blah. And then you look at the graph. The price of the average used Tesla has gone from $67,000 to 22,000 now? 28,000. So it's down 58% in 2.5 years. So, just off by a little bit. But at any rate, I tweeted that out. And then there was also another article I tweeted out. It came out. It was a story. Where was? Oh yeah. So when I tweeted that out, some guy got really pissed off at me. And where the heck was this? I gotta find this. Hold on. He went after me because I think this. I'm trying to find it. I think I had taken a link from. I think the data had come from CBS Broadcasting, and this guy was nasty as all hell. Or what he throws political nonsense into what's a financial discussion. He's like, "Oh, CBS, they're terrible. They're left wing, whatever, yada yada yada." Okay, now the fact of the matter is, I don't like CBS, but that's neither here nor there. Why he had to inject partisan politics into what's a pure numbers discussion about the resale value of Tesla cars was just beyond me. I mean, you could go on, Edmunds used car site or wherever you want. You can find this from any of a million places. But this guy he wouldn't give up. And so I said, gee, take it from CBS, take it from anywhere else. So I think I took it from the Wall Street Journal or something. I put something else up, and he goes, "Oh, the Wall Street Journal. They're also globalist. They're woke. They're left. Whatever. I can't remember exactly what he said." Anyway, the point of it is, Dilly, you see this all the time. Why, when people do stuff like that, it's because they don't have a substantive comeback. They have to,
Yeah.
but why people have to throw politics into everything? It's one of the things I just can't stand about Twitter. It's got nothing to do with it. All right. Here
Yeah,
we
but
go.
that's what sells on Twitter, I feel
Oh, well,
like.
here's another one. This is this guy, Johnny123. His handle is, here we go. You're going to put this up in the nest. Okay. At Dad loves USA 101. He goes, doubt Elon long term and you will be losing on the losing end of the trade. Okay, fine. That's fine. And then he goes, and the mainstream media like the New York Times is straight garbage at this stage. If you trust them, you are a fool.
Mm-hmm.
So I responded, logical fallacy by you. Classic response in lieu of a substance. Tesla used car prices are collapsing. Shh. This is secret information. Don't tell anybody else. Okay. And then he goes, I love this one. They aren't a car company long term. I'll take Tesla. But anyway, the point I wanted to make here,
Yeah.
and we could talk for a few minutes. Anyone wants to come up and discuss this? People just the number of and I know we're going to space this at some point. I think I mentioned a few weeks ago about logical fallacies. People just start going batshit crazy. Oops, I used it's the first four-letter word I've used in this space. They have to put politics into stuff.
Mm-hmm.
Politics, ad hominem, personal attacks. It's like, what is wrong with
It's the
people, Dilly?
internet, George. Like, people are keyboard warriors out there. It's not like we want it to be like
It
a
really,
conversation with like somebody reasonable or like similar to ourselves, but they're just not.
Rusty?
I, I think, that's why I love guys like David Trainer, see Dave Nikoski down there. It's like, there's, here's the facts. That's what it is. Trade with it, invest in it, do what you're going to do with it. That's it. It's not an emotional thing, but man, the people who get so tied to this. I'm like, I was explaining to someone, I said, okay, let's see. You go buy a small business that is, I'll just say it's facing some headwinds. Your return is going to take you what, 55 years. Do you want to go and invest in that?
Right.
I mean, really, like just think of it from the angle of a small business purchase, and you would say, heck no.
Right.
I mean, just would. That's why, I mean, fundamentals is one thing, trading is another, right? It just depends on what you're going to do with it. You can trade on it, but man, I wouldn't. I don't know. That's just me.
Yeah, no, and I think I used the line earlier in the space with David. Liars figure, but figures don't lie. And there's always sometimes, Jilly, on Twitter, it's like people say facts in capital letters, exclamation point. All right. When you present, what Rusty was saying, when you present someone with facts, not opinions, facts, like it's kind of hard to get around facts. And it just drives me batshit crazy that people do this stuff. It's just nuts. Oh, here it is. I found the other thing I wanted to put up there. Okay. So we're having, by the way, I'm gonna show for oh yeah, I have to show for our space tomorrow as well as the space next Tuesday. So tomorrow, so Dilly, remember we had that space last week, I think it was Friday, where we had the guy from Mexico talking about what's going on in Mexico.
Yes.
So tomorrow we're having a
Oh, we're
very
doing
deep,
Greece,
we're
right?
doing Greece tomorrow
Yes, with
and
Abe.
talking about cost cutting and like Doge can happen here or whatever.
Oh, I
And
can't wait.
I want global macro guy. I
Yes.
want him to come in and respectfully, global macro, if he's still here, respectfully engage with the guest speaker, because I think it's going to be very interesting to hear how Greece did this. Is it all puppy dogs and rainbows? No, but is it interesting what they had to go through? Very much so. So everyone should come to that. The other space that I'm really excited about, this guy, I think sung his praises the other day. I encourage everyone to start, retweeting tweets that they like from other people and calling out good actors, people that are adding to the community. Okay, so we're having a speaker in on Tuesday. He has excellent tweets and he's got like 118,000 followers. He runs a small fund in New York. I did not know of him until I saw his Twitter account. His name is Spencer Hakimian. I spoke to him yesterday, Tulu Capital Management. Really good guy.
I
And
shared both
Oh,
of
heck
those to
yeah,
the
you
nest.
got him? Awesome. Sorry to.
yeah, I got him next Tuesday, and apparently his track record is really good. So he's not a LARPing guy who just does good tweets. He tweets really well, but he's pretty smart too. So I think we'll learn a lot from him. But at any rate, so I know what it is. So I just put up in the nest. Um, There's the last tweet I put up here. Dilly, if you look at it, I put up in the nest, I'd cited something from, oh yeah, I know what it was. This had to do with Doge. So Spencer had tweeted out something about how, this fiscal year, the 5 months, 6 months ending June or 5 months ending February, spending is running up year on year. And we've talked about this a lot before. There is no austerity. It's bollocks, as our Brit friends would say. There is no austerity. So in any event, he tweeted out a similar thing, and just he put it differently. So I thought it was interesting. So this guy Bob Rice, if you look in the nest, Dilly, you'll see it. This guy Bob Rice like attacks me. Okay, he goes, you can see it. He goes, anyone citing CBS as a source is probably spreading BS. And so Spencer's comment about the budget deficit blowing out, it just came from CBS. But you can get it from a million sources. I think I followed up with the same article, but the same story from the Wall Street Journal. You could go from the office of the budget office, the Congress, whatever. These are facts. These are not opinions. Okay. So what does this guy do? I'm sure he's a nice guy, but this is, again, as you would say, Jilly, the hellscape that is Twitter. Okay. I respond, but he says anyone citing CBS as a source is probably spreading BS. I said go pound sand. The information is widely available, and I put a link to the Wall Street Journal. He responds by saying the Wall Street Journal is no more credible than CBS on globalist issues. And then I put pick any source you want to rebut these numbers I cited. I dare you because you cannot. I mean, Dilly, what is wrong with people?
I think
Eh,
I think people just love to get your goat.
Yeah, but you know what? I didn't use any four-letter words. I just told. I mean, I mean, they might. That's fair if you think that. But I also think when I torch them with facts, it's a pretty stupid look on their part.
Yeah, yeah. I mean, it's the
I mean, they
internet.
make fools of them. They make fools of
They
themselves. I mean,
make
you
fools
know.
of themselves going against you, George. That's true.
Well, I don't know. Listen, I make a lot of mistakes. Not the point, but
Look at
why
Dunkin'
people?
Donut. He made a fool of himself.
Well, yeah, made a fool. Yeah, he's a complete flaming. You know what? I'd love for him to come in here.
Did you
But
block
whatever.
him? Or
You know
he
what?
just blocked
You
us?
you know, I blocked him. No, he
Oh.
blocked us. He blocked us first. He blocked us first. He
Yeah, but
blocked
I
us
didn't
first.
block him. I wouldn't. Did you block him? He can't come in if you blocked him.
I blocked him. You know what? If I blocked him, I'll unblock. I'm not
I
even
think
sure that
we
I
should have
did.
an unblock party or like a part like a
No, if I do an
no,
unblock
no,
party,
no,
how am I
no, no.
gonna?
Listen, I think we should have like people that want to be unblocked can submit their name to a list, and then they can come up in a space, and it'll be the
All right,
the
all
block
right. So
party with
that,
George and Billy.
that's an idea I can get behind.
Because I have a very large block list as well, George. I'm not criticizing you at all. I'm just saying
No, Dilly,
we could have some of our
Dilly,
haters come up and ask to be
Dilly,
forgiven.
Dilly. My block list,
George.
Dilly. My block list is bigger than yours.
Wait, I think
I
mine is
was
bigger
about
than
to say,
yours.
I bet George has a mile long.
Wait, we should make a vote who has a
We should
bigger
do a
block
poll.
list.
All right,
George,
You,
I'll do the vote.
Dilly,
Hold on.
you do the poll. All right. So
Yeah.
Dilly, I have such nobody knows more about blocking than I do. I'm an expert in blocking. Okay, seriously, I've been told that they've never seen anything like it. A block list like mine, it's never been seen before. So anyway, all right. So we got a couple guys left. I'm going to close this down shortly. So
George has more people blocked than available.
Rusty, maybe we should do this the other way around. Maybe if we just let people up that were unblocked, that would be a lot simpler, quicker than to go through the block list. All right. So I'm going to mispronounce. No, I want to go to HTS because he was disappeared. Now he's back. HTS, if you're there, unmute yourself.
No, thank you, George, for can you hear me?
Yeah, we got you.
Yeah.
Yeah, the
So
poll is in the nest, guys, by the
no,
way.
thanks for
Continue.
yeah. Oh,
Sorry.
good. I just wanted to tell you guys a story. First off, I personally I know Tesla is the next Enron, and I've been shorting it for quite a long time. But just my little background. I'm involved with tube transportation for over a decade now, and I'm part of a consortium. We actually met Elon Musk in 2012. And I just want to let you guys know he's an absolute pathological liar. He actually assured us 30 million in funding involving this tube transportation.
HTS, I just want to let you know you already have earned most favored nation status. Just you're a member of the club. Keep going. I like you, HTS. Go on.
Well, let's just talk about Tesla because what are your theories on what kind of accounting fraud I think it's just like Enron all over again. I'd like to hear your thoughts about Tesla.
I don't want to go into that right now. I'll let Motor talk about that just because
Sounds good.
I'm getting tired. But HTS, could you just finish with your anecdote about
Yeah.
what,
So
and then I'll let Motorhead speak to that. But finish with your anecdote about Elon Musk.
essentially, Elon threw us under the bus with his Hyperloop crap, and
Oh God,
yeah,
oh God, go
but
on. Yep.
essentially the Chinese have been developing a tube transportation system with hundreds of peer-reviewed papers. They're way ahead of us, and they are going to be connecting their cities thousands of miles per hour in the next decade. So, in regards to big infrastructure projects, it's very real in China. So, I'll
So
leave it there for the
he
future.
basically just sold you guys a backalize and threw you under the bus. All right,
Yeah.
Motorhead, if you're still there and have the energy, you want to speak for a minute or two about not just the bear case, but maybe speak to the accounting part of it and the dishonesty of Elon, the broken lists of promises. Although we don't have all day, but go ahead, Motorhead.
It's really. I mean, I'm convinced that there's a lot of accounting fraud going on. I personally visited, one of their major suppliers who told me that when they were trying to ramp up the Model 3 back in 2018 or 2018, they were having a bunch of production problems, and they sort of over-ordered parts, considering they were behind on their sort of ramp up of the Model 3. They straight up told these guys to hold the orders, and they'll pay them a little bit extra if they hold it for like 1 quarter, And what it does is it at the time, because they were like junk bond status back then. They're only one notch above that now. But the point is, they inflated their cash flow by a significant amount in like I think Q2 or Q3 of 2018, just by having the supplier hold parts that they ordered and they didn't want to pay for or hold in inventory, which would have been, pulled back on their cash flow. So anyway, but I've tried to, I dig and dig. We all do, every quarter. I think it's going to be very hard to find stuff unless you've got an inside lead, like sort of like I did when I talked to the suppliers.
Yeah. So HTS, you struck a really rich ore body here with this Tesla question, and we could go on for days talking about this, but in the interest of time, given that we're an hour 45 into this space, if you don't mind, come back to another space. We'll be happy to talk about it. We can get Motorhead back to he can give us school will be in session. So thanks for the question, Maglev. All right, Dilly, it's an hour and 45 minutes. Enough.
Enough. Our poll
You
currently, though, George, is at 10 votes, and 50% say you and 50% say me.
Oh
So
man.
we both
All
have
right,
5
cool.
votes.
All right, there we go.
Well,
All
let's
right.
reveal tomorrow who has a bigger blacklist.
All right.
I'll tell you how to find out how many people you blocked.
All right, sounds good. All right, thanks to everybody. Motorhead, Rusty, Dilly, Maglev, Dave's not here anymore. This has been awesome. Tomorrow should be really interesting. So come on, come all. Thanks, Dilly. Good night. See you guys. Take care.
Bye.
Bye. Bye.